This little cup could be the difference between broke and a millionaire.
Every finance guru says the same thing: stop buying coffee, retire rich.
But is that actually true, or is it one of the biggest myths in personal finance?
Today on StickBusters, we're testing the Coffee Millionaire myth.
We're going to run the real numbers, the math, the myths, and the reality most influencers leave out.
Let's bust this thing!
StickBusters.
Every week, we take the money myths everyone repeats and test them with real maths.
No hype, no get-rich-quick nonsense, just numbers.
So, can a $5 coffee habit really make or break your retirement? The myth comes from a real financial concept called the Latte Factor, the idea that small daily expenses add up to a fortune over time. The theory: skip one $5 coffee a day, invest that money instead, and decades later you're sitting on serious cash.
One coffee, every day, multiplied by decades. That's the pitch.
Sounds too good to be true, right?
That's exactly what we're here to test.
First, let's set up the experiment. One coffee a day, $5 each.
That's $35 a week.
About $150 a month.
And just over $1,800 a year.
Okay, that's already more than I expected, but does that turn into $1 million?
Test 1, the simplest version. No investing, just stuffing the coffee money into a piggy bank.
$1,825 a year, saved for 10 years with zero investment growth.
That's $18,250 after 10 years.
Not bad for skipping coffee.
Sure, but that's only 10 years. What about a full working lifetime, say 40 years? $1,825 a year for 40 years, no investment growth at all.
That's $73,000, a meaningful amount of money, but nowhere close to $1 million.
So just saving the cash under your mattress, that alone does not make you a millionaire.
Right, because the real magic isn't saving, it's investing.
This is where compound interest enters the picture.
Think of it like a snowball rolling downhill. It picks up more snow the longer it rolls.
Your money earns money, and then that money earns money too.
So let's run the real test, investing the coffee money in the stock market.
Historically, the US stock market has averaged around 10% a year before inflation over long time periods.
To keep this realistic, we'll be conservative and use 7% a year adjusted for inflation.
7% a year is the commonly used long-term average for a diversified stock index fund after inflation. $5 a day invested at 7% annual growth for 10 years.
After 10 years, that grows to roughly $26,700.
Already better than the piggy bank, but we need to go bigger. 20 years.
At 20 years, the total climbs to about $78,900.
Now we're talking. Let's push it further. 30 years.
After 30 years, the total reaches around $184,200.
Okay, that's genuinely a lot of money, but still not $1 million. Which is exactly why the classic version of this myth talks about a full 40-year career.
This is where compound interest really shows its power. The curve isn't a straight line, it explodes upward.
After 40 years, $5 a day invested at 7% grows to approximately $438,000. $438,000 from coffee money? Impressive, but that's still under $500,000. So where does the millionaire number actually come from? Many viral versions of this myth assume a bigger daily habit, 2 coffees a day, or about $10, not just 5.
At $10 a day for 40 years at 7% growth, the total reaches roughly $876,000.
Stretch the timeline slightly or bump the return a bit higher, and yes, the number does cross $1 million.
So the math checks out. It is mathematically possible.
Mathematically possible, but math on a chalkboard and real life are two very different things.
So let's stress test this myth against reality.
Time to bring in the real-world complications.
Complication 1, 40 years is an enormous, unbroken stretch of consistency. No skipped months, no dipping into savings for an emergency, no missed years. Real life rarely works that cleanly.
Complication 2, inflation. Prices rise over time, so $1 decades from now buys less than $1 today.
That's actually why our 7% number already accounted for inflation, so the math there was fair.
Complication 3, taxes. Investment accounts can be taxed on gains, which quietly shrinks the final total.
Tax-advantaged retirement accounts can reduce this bite significantly, but it's rarely zero.
Complication 4. The stock market doesn't move in a smooth, straight line. It goes up and it goes down, sometimes sharply.
A market crash at the wrong moment can wipe out years of gains, at least temporarily.
Which is exactly why the 7% figure is a long-term average. It already includes the crashes and the recoveries.
Complication 5. Life happens. Car repairs, medical bills, job loss. These can force people to pause their saving plan entirely.
This is the biggest gap between the myth and reality. Perfect, uninterrupted saving is rare. There's also a deeper critique from financial experts. The Latte Factor focuses on a tiny expense while ignoring the bigger picture. Housing, transportation, and debt payments are usually hundreds of times larger than a daily coffee and have a far bigger impact on wealth.
So obsessing over coffee while ignoring a car payment or high-interest debt kind of misses the point.
Exactly. Income and big expenses matter far more than small daily habits.
A raise, a career change, or a side income can add thousands of dollars a year, often far more than any daily habit ever could. But, and this matters, the two ideas aren't actually in competition. Cutting small expenses and growing income work together. They're not an either-or choice.
Small savings just work best as a starting habit, not the entire retirement plan.
So let's put it all together with one real relatable example. Meet Sarah. She's 25 and she drinks 1 coffee a day on her way to work. At 25, she decides to redirect that $5 a day into a simple low-cost index fund. In her 20s, the balance grows slowly. This stage always feels the slowest. By her mid-30s, consistent investing has already built roughly $45,000. By her early 50s, the total has climbed past $155,000. By age 65, 40 years of consistent $5 a day investing, Sarah's coffee fund has grown to roughly $438,000. Not quite a millionaire, but a genuinely life-changing amount of money, built from something as small as coffee.
And if Sarah also gets modest raises over her career and increases her monthly investing along with them,
combined with other consistent saving habits over a full career, crossing $1 million in total net worth becomes realistic for many people, not because of coffee alone, but because of consistency over decades.
The coffee habit wasn't the whole story. It was the starting spark that built a lifelong habit of investing.
So where does that leave our myth?
Let's recap what we found.
Fact 1, invested consistently over decades, coffee money can genuinely grow into hundreds of thousands of dollars. Fact 2, under certain assumptions like a bigger daily habit or a longer timeline, it can technically cross $1 million. Fact 3, coffee alone is not the main driver of that wealth. Income, big expenses, and consistency matter far more.
Fact 4. Real life rarely allows 40 perfectly uninterrupted years of saving, so actual results are usually lower than the pure math.
So here's our verdict. Verdict, plausible.
The coffee myth isn't a lie, it's an oversimplification of something real.
Small, consistent habits invested early and left alone for decades really can turn into serious wealth. Just don't expect the coffee cup to do all the work by itself. The real takeaway, start early, stay consistent, and let time do the heavy lifting.
And hey, if you genuinely love your coffee, this isn't about giving it up entirely.
It's about knowing where your money goes and making sure at least some of it is working for your future.
That's this week's myth busted down to the numbers.
If you want more money myths tested with real math, make sure you're subscribed and ring the bell so you don't miss the next one.
Got a money myth you want us to test next? Drop it in the comments.
Until next time, stay curious and keep busting myths.
StickBusters.
Thanks for watching.
See you in the next episode.